Welcome back to the channel, everyone. Nick Armenis here, and in today's video I'm going to cover off Appen. Appen is a stock I am a holder of. It trades under the ticker ASX APX, and in today's video I'm going to do a bit of a deep dive on it because the deep dive approach seems to be what you're all most interested in, and it's the best feedback I've given. Guys, if you do enjoy this content, please give the video a thumbs up, subscribe, hit that notification bell, and leave a comment. It really helps the channel grow, and I want to lift the level of analysis that you see on YouTube. Okay, so let's get into today's content, guys. But before we do, please note I am not a financial professional and this is not financial advice. So step one, I always like to get an overview of the company. I like investing in businesses I understand. While I do some, swing trading as well, I always need to know what the business does. Is it a good business, or does it have the potential of becoming a good business? So what does Appen do? Appen provides data solutions and services for machine learning and artificial intelligence applications for technology companies, auto manufacturers, and government agencies. It operates through two segments, guys: relevance and speech and image. What this actually means is Appen is putting in all the back-end data, all the grunt work, doing all the grunt work to make these AI and machine learning algorithms work and deliver high quality, and it delivers high quality training data for these businesses, right? They've got some really big clients in the technology space and in automotive and things like that. The reason this is quite exciting, guys, is AI is just going to be used in almost everything, and you just see by these 6 dot points. So search, there's 3.5 billion searches per day. There's tons of data that needs to be analyzed in autonomous driving, which it'd be impossible for just humans to do. You need the work of AI to learn and become smarter. Virtual reality, chatbots, voice assistants, and e-commerce. So Appen is currently trading at $16.38. It's way off its 52-week high of 43.66, and I guess that's kind of the crux of this video, where I guess my main argument is it's probably been oversold, and given it's one of the few wax stocks that is actually profitable and pays a dividend, it does still trade on an expensive PE. I think this is not a bad little investment for myself personally to make. And I guess by the end of this video, I want to give you enough information to go and do some further research and work out, is this a good business? So let's try and understand a bit more what they actually do. What is relevance and speech and image? So the relevance segment offers annotated trading data. So the inputs that go into AI are obviously vital. If you put in bad data, you're going to get a bad result. So these guys ensure that the data that goes in is high quality. And so the trading data, which is used as an input to enhance the performance of search engines, social media, and e-commerce applications. So it's all about making things like the Google search engine better, all about making autonomous driving cars better. The speech and image segment provides training data that is used to build AI voice interface. So anything to do with voice, translation, text analysis, augmented and virtual reality, and image perception systems. So again, this would be used in things like autonomous vehicles, in your voice assistant in your phone, and things like that. So how do they make their money? This is important, right? So by collecting and labeling images, text, speech, audio, video, and other data used to build and continuously improve the world's most innovative artificial intelligence systems, they utilize this massive workforce, over 1 million people in tons of different countries and locations, and the industry's most advanced AI-assisted data annotation platform. So they have an AI platform that assists in the annotation as well. And the software side is what I'm excited about, and this is what needs to grow in Appen for it to become, to get a PE re-rating and become, a business that people value more. It needs a bit more recurring revenue and to become more of a software business rather than, it's a little bit like an Uber for machine learning AI annotation, just because, they don't employ all these people, they've just got access to them. So it's almost like if you've used Fiverr or Upwork or anything like that. They've got a platform, people offer their services, and then they get matched with jobs and things like that. So it's not really a software company. It has an element of software to it, but it's really a contract service business. So people can actually buy data sets they already have. So if you have something that's somewhat generic, they may have a data set available. Maybe you're building a database on birds and they've already got all that annotated. You can pay them by that direct, or buy training data for AI, or just pay them to collect and annotate data or engage them in other services or projects related to this industry. So that's how they get paid, on a contract basis mainly, or job basis. Company growth and strategy. So the AI global spend by 2024 is going to be 110 billion. Obviously, it's used in a ton of industries now, but there's tons we don't know about as well, and that's also what's exciting. So there's growth in online advertising, e-commerce, voice interface, new AI use systems that we don't even know about, autonomous driving, automated machine learning for model building. So it's growing rapidly at 24% annually. So it's an exciting space to be in. Obviously, Appen services are vital to making this grow. The other growth driver they have is China is growing quite fast for them. Obviously, it's off a small base, so I know that they're probably pushing this a little bit too early as growth, but I'm sure that this will, get much, much larger and become a big part of their business. Revenue growth of 60% for the quarter. If it keeps growing at this rate, or thereabouts, it could become a big segment for them. Includes major Chinese technology players, like I'm assuming Alibaba, Tencent, things like that, and then NIO for the growing autonomous vehicle market there. So the margins are improving there as well, which is awesome. And the other reason, guys, that I guess Appen's quite a trusted person in this space, and they've got a bit of a moat, is you need to be careful of people's data in this. You've got some big, massive companies' data, and it needs to be kept safe. And so a big company like Appen is a prime person to hold it, right? You're not just going to go to some backyard person to do this. So growth investments, they're obviously investing in sales and marketing, because a lot of what I'm talking about, guys, is from the recent earnings update, because obviously that is the most recent news we have. So they had 136 new customers, 34% increase in number of projects with major customers. So they actually got existing customers to spend more with them. New customers, projects, and use cases in all geographies. It's underpinned by the annotation platform. So the platform is very important to this business. And as you can see, there's a bunch of industries there, payments in tech, media technology, financial banking, aviation, writing assistant. There's tons of different uses for this business. So it's got a very big addressable market, is what I like. So government is another area they're planning to grow in a big way. They're already there, but they're trying to get into other government departments within the US, because it's obviously very big. But you need to become a registered, and I guess get all the tick of approval for data and cybersecurity and things like that. This has been hampered by COVID-19. So a lot of what happened and why this stock has been crushed bad is sales lag because of COVID-19 and also the presidential election. So they're going to keep building this pipeline, and over time it should grow to be a big part of their business. Technology is where I want to see Appen grow. A lot of this stuff here, while it sounds okay, I want to see some really big leaps coming from them in technology, and I guess being able to offer this as a software as a service kind of model. If they're able to do that, then this PE will re-rate, and it might go to 50, 60. It'll grow in a big way, maybe even higher. Some of the wax stocks are trading on like 120 PE, and that's because they're growing fast and they've got recurring revenue and higher margins. So technology will allow Appen to lift its margins, and I think it's going to be able to do it. All the talks of what's happening is they're working on stuff. I know it's been a while, but this sort of stuff obviously does take time, but this is what I want to see grow. So let's look at the actual numbers and financials. As you can see, steady uptrend for revenues, obviously slowing down a little bit in the last 2 years, but I'm assuming because of what they've said is COVID's impacted that. Operating margins seem to be dropping a little bit, which is not good. They're still healthy, around that 18% level, but I want to see that grow to, over 20, and then it's going to be quite a solid little business. And then net profit is increasing over time too, which is awesome. Recent earnings update, they had 12% increase in group revenue, 15% in relevance, but the image has been, speech and image has been the one that's been impacted. EBIT is up 8% and margins are dropping a little bit. Dividend growth. I'd rather they spent that money on the dividend within the business personally. And guys, the reason the drops happen is obviously speech was down, which is not good. And then relevance, people expected it to be higher. So people expect this business to be going, 20 to 30% a year, and it just didn't do that this quarter, or this half, sorry. And so people are not a bit cautious of it, because they're like, we want to see that growth return. So otherwise, it's a business that's quite healthy. It's just a valuation issue at the moment. And at $43, $44, it did get a little bit out of hand, but I definitely could see this stock being in the high 20s or early 30s again in the next 2 years, no dramas. So again, Ongoing revenue commitments and annual contract value have increased, and then projects committed have increased as well. So, the annual contract value has now has increased to US 124.4 million, which is really, really good, guys. New customer and project wins has been, as we talked about before, increased by 34%, which is awesome. And then the China revenue has grown. So again, we're looking at a business that's in pretty good shape. Catalysts and narratives. So the outlook was also what let them down. They, I guess, probably positioned a softer outlook than many people thought. But I mean, if they can get that growth back to, mid 20s, even low 20s, it's probably going to pop in a big way. Even if they can get just that 18% growth in EBITDA that they've promised, I think it'll do quite well. And then the EBITDA margins are saying at high teen percentages. I want to see that push past 20. I think, again, if they do that, it's going to do well. Some of the near-term challenges that you need to be aware of is, the strong Australian dollar seems to have kind of gone away as an issue. Not gone away, it's still there. It's not as promising as it once was for them. So, if they earn a lot of money in US dollars, when they convert it back to Aussie dollars, they've won, right? When the opposite happens, they've incurred, a 4x loss. So obviously it impacts their EBITDA and profitability. And impact on major customer priorities and resource allocations. I don't know about this. I feel like this is an industry that people would have spent more on, potentially temporarily as the pandemic ramped up. People didn't know what was happening and they paused projects, but maybe it's just taking a bit of time to get those back online. Let's see. Let's wait and see for the next update as to what happens there. So it's also strongly positioned for the long term, obviously, because AI industry tailwinds, growing adoption, use cases. This is the largest global player. It's got the best technology, growth investors delivering new customers, more projects, growth in China, all the things we covered off. AI-enabled technology platform. This is what I want to see grow, and adapting in sync with our major customers. So obviously they need to keep up with what their major customers need. Here's what I see as the key catalyst for growth, apart from what I just said. So growth in AI spend continues to expand globally. Data sets and annotation are key in any machine learning, so Appen is needed for that growth to occur. Customer growth is still strong, guys, and there's just minor delays in sales. These are likely to be temporary, in my opinion. We'll wait and see. Appen's workforce scale, expertise, and reputation are hard to replicate quickly. Small moat, so it should continue to attract good clients. Soft earnings, growth, and outlook may be a temporary blip because demand is still strong for what they provide. The key risks, though, if competitors are actually growing and they're losing market share, obviously not good, could be a possibility. Customer projects may become smaller for Appen, or as competition increases, pricing gets put under pressure and potentially margins. COVID delays may extend and become permanent. That's a possibility. Growth won't be as robust going forward. Again, this is why it's been marked down in the first place, so it could occur. Margins aren't huge, so they should focus on more of a SaaS type business model, in my opinion, rather than more of this brunt workforce, potentially even keeping what they've got. I'm not saying get rid of it, but just focus more on the software. And if downgrades continue, going to be an issue. Let's have a quick look at Simply Wall Street and see what it says. So it's saying that it's in good financial health, has a decent past record, and future looks okay. So the things it highlights are earnings are forecasted to grow by 20.32%, and earnings grew 21.3% over the past year. So obviously not a bad little thing, right? APX is not significantly more volatile. I don't know about that. I mean, in the last week potentially, but over the last 6 months, 3 months even, it definitely has been. It's definitely underperformed the market on a 7 and 1 year basis. But if you look at your 5-year returns, you're crushing the market. Even your 3-year returns, it's just in the last year. And something like this is going to be volatile. But these are the type of things, guys. It opens up opportunities for people to buy, right? So it's on 39.44x valuation, It's saying that it's 19% overvalued. I'm not sure how this fair value is calculated, actually. It's something that I might actually ask Simply Wall Street. PE, the Australian IT and technology industry is, I guess it has a lot of companies in there lumped in that don't have high PEs, and that's because they're not really software companies. Appen's kind of in between a software company and a hardware company or a services company. So 39 PE is still expensive, but if earnings grow enough, it won't look expensive, right? But yeah, as you can see, we want to see that PEG ratio get better and improve. Price to book, it's slightly overvalued on that basis. Future growth, earnings are still growing relatively quickly if you look over the next few years. So, you're at 600 million in revenue and you're going to go up to 841. So it's a pretty big jump over the next few years, and profits are going up as well, another 40 million. So around 50% profit increase. The only thing that kind of gets marked down here is revenue is going to grow slower than 20% a year. That's its main marker. It's being marked down here on. EPS is meant to grow quite quickly as well, which is good. Its return on equity is saying it's going to be low in 3 years' time. 14.5% is the forecast. Again, I'm not sure how this is calculated, so take all of this with a grain of salt. Past performance is good, so it's got high quality earnings, and consistently. It consistently does well, but here's the major thing we're getting from this. Everything is doing well. People are just worried that it's not going to continue. But you look at everything, return on assets is good, return on capital is pretty good, financial health, it's got way more than enough money to pay its debts and pay for any liabilities it has. It only has $77 million in liabilities for the short term and 36 for the long term. So let's have a look at that. It's debt free. Okay, so that's actually another thing that actually happened in the last year. They paid off all the debt, which is amazing, right? This is the type of businesses that, if we weren't in this environment, would be doing well. So I like seeing that. Me personally, I think they should just scrap this dividend until they become a bit more of a mature business personally, but I'd rather they invest that in software or technology. The only thing you'd probably want to do more research on, guys, is just have a bit more of an understanding of the CEO and I guess some of the key people in the company. Everyone seems to have been there a while. I guess this person's only been there 1.75 years. And then the board members have been there for over 6 years. So, and then you've got someone that's been there 11.67 years, which is great. And there is some good insider ownership there. You've had quite a few, let's see, you've had a few insiders selling, but also insiders buying as well. So, there's nothing too dramatic there. So there's not enough data to work out whether or not it's a good or bad thing according to Simply Wall Street. General public owns most of this, so that's probably why it is a bit more volatile. It's very retail driven, obviously, and insiders own 8.7% of the company, which is not huge, not something too worried about. But obviously, Christopher Von Willer, I'm not sure if he was the founder. I'd have to double check that, but he has 148 million in shares, so potentially he was the founder. I'm just not too sure. Let's have a look. And yeah, that's it for the Simply Wall Street portion. Let's finally go to would I actually buy, my opinion. I'm actually already in this stock, guys. I'm in it for the long term. I'd prefer the company invest more in technology, as I said, and build out that moat, have more of a SaaS model and improve margins. It's down almost 60% from its high. I think there's a good risk reward here to making, potentially, it's probably not going to go back up to that $44 level for quite some time, but over the medium term, could easily see it in the high, even mid-20s relatively quickly, high 20s in the next year, potentially 6 months, and then over the next 2 years, it will head towards, I guess, that 35-ish level, in my opinion. I think over the medium term, it's going to be bigger, guys. The PE of 40, while expensive, is nothing compared to the other wax stocks, a lot of which aren't even profitable. This is. So, guys, that's my analysis on Appen. I hope you've enjoyed it. If you have, please subscribe to the channel. Leave a comment below with what you thought of the video, and if you're a holder of Appen or what you want me to look at. So, see you in the next video, guys.